Warren Buffett is wrong about gold, and it's costing investors a fortune. For decades, Buffett has warned investors away from gold, calling it unproductive and inferior to owning businesses that generate income. And he was right. Until now. Because today, gold isn't just a store of value. It can actually generate an income, a real yield paid in gold. And once you see how it works, you may never look at your idle gold the same way again. So let's start off by being fair to Warren Buffett. The legend told the world that he would be retiring from Berkshire Hathaway this year and will likely go down as one of the most successful investors of all time. His understanding of the benefits and dangers of investing in certain asset classes is truly second to none. In his 2011 shareholder letter, Buffett outlined three categories of investments, or at least the way he sees them. One, currency-based assets. These are things like cash or bonds. Two, assets that will never produce anything, like gold. And three, productive assets, like businesses, farms, or even real estate. Buffett is spot on when it comes to the pitfalls of owning cash or bonds, and dead wrong when it comes to owning gold. Buffett's strategy has long emphasized buying undervalued, productive assets, such as companies like Apple, Coca-Cola, or even Bank of America, and only holding currency-based investments, assets like cash or bonds, only when equities become overvalued. Interestingly enough, Buffett is now one of the largest owners of treasury bills in the whole world. Berkshire Hathaway has amassed $300.87 billion in US treasury bills, accounting for nearly 5% of the entire market for short-term government debt, according to the company's latest financial disclosures. What's even more incredible is that Berkshire Hathaway now holds more US treasury bills than the Federal Reserve. What does that mean for his opinion on investing in stocks and their valuations currently? You can let us know what you think in the comments. But let's start off with what Warren Buffett gets right, especially about currency-based investments. Here's a quote from his 2011 shareholder meeting on the dangers of investing in currency-based assets like cash and bonds. Here's the quote: "Investments that are denominated in a given currency include money market funds, bonds, mortgages, bank deposits, and other instruments. Most of these currency-based investments are thought of as safe. In truth, they are among the most dangerous of assets. Their beta may be zero, but their risk is huge. Over the past century, these instruments have destroyed the purchasing power of investors in many countries, even as the holders continued to receive timely payments of interest and principal. This ugly result, moreover, will forever recur. Governments determine the ultimate value of money, and systemic forces will sometimes cause them to gravitate to policies that produce inflation. From time to time, such policies spin out of control." That is Warren Buffett at his best, exposing how supposedly safe assets like bonds or even cash can quietly destroy your wealth through inflation. And he's absolutely right. Currency-based assets often fail to preserve your purchasing power over time because of the debasement that paper currencies are prone to. Just before announcing that he would be stepping down as CEO of Berkshire Hathaway, his last statement, following a comment about societal progress over the last 100 years or so, was as follows, quote, "I do think that fundamental to all of this is having this currency that does not get debased. What that does to the stability of a society where all the people that trust their government get screwed and all the people that figure out ways to profit off of it become rich or richer, I don't think you want a society that operates in that manner." Here's another quote on the dangers of government-managed currencies from Buffett himself. Quote, "The natural course of government is to make the currency worth less over time." Spot on. But then Buffett turns to the final category of assets, which he calls assets that will never produce anything. And this is where he is dead wrong. Quote, "The major asset in this category is gold. Currently a huge favorite of investors who fear almost all other assets, especially paper money, of whose value, as noted, they are right to be fearful. Gold, however, has two significant shortcomings, being neither of much use nor procreative. True, gold has some industrial and decorative utility, but the demand for these purposes is both limited and incapable of soaking up new production. Meanwhile, if you own 1 ounce of gold for an eternity, you will still own 1 ounce at its end." That is the heart of Buffett's objection to gold. It doesn't do anything. It just sits there. But Buffett's critiques of gold hinge on one major assumption that gold doesn't produce anything. That used to be true. Today, it isn't. Ever since monetary metals introduced gold leases and gold bonds, thousands of gold owners now earn a yield on their gold holdings. These gold fixed income products transform gold from a passive store of value into a productive income generating asset that generates a real yield paid in more ounces of physical gold. In gold leases, clients lease their gold to qualified businesses for use as inventory or work in progress, and they can receive anywhere between 2 and 5% yields on their gold paid in more gold. In gold bonds, businesses with gold assets or gold income, like gold miners for example, prefer to borrow in gold so they can match their assets, gold, with their liabilities, gold. Investors in gold bonds have earned annual yields between 6% to as high as 19% paid in gold. By turning gold into an income-generating asset, gold leases and gold bonds directly address Buffett's critique that gold doesn't produce any income. So, should Buffett own gold? It's unlikely that Buffett's gonna change his feelings towards gold at 94 years old, although we wouldn't refuse him if he wanted to become a client of monetary metals. But if he did take a fresh look at gold, he might notice that modern gold fixed income products are actually remarkably aligned with his own investing philosophy when it comes to productive assets. Here's a quote from Buffett. Ideally, these assets should have the ability in inflationary times to deliver output that will retain its purchasing power value while requiring a minimum of new capital investment. That, to me, sounds an awful lot like a gold with a yield. Or what about his famous quote? It's a lot better to have a goose that keeps laying eggs than a goose that just sits there and eats insurance and storage and a few things like that. Well, we totally agree. That's why we offer complimentary storage, complimentary insurance, and of course, yields paid in gold. Back in 2011, when gold was sitting at just $1,405 per ounce, and Buffett made his famous remarks about gold, 100 ounces was worth about $140,500. If you had earned a 4% annual yield in gold on those 100 ounces, you'd now have nearly 160 ounces, worth approximately $528,000 at today's price of $3,300 per ounce. That's an additional 60 ounces of gold, or about $198,000, which is more than just holding the gold itself, of course. That's not bad for an asset that Warren Buffett said, quote, will never produce anything. For those interested in owning gold as an income-generating asset, click the link in the description below. Thank you so much for watching. Make sure to like this video, subscribe to the channel for more investing videos about gold, and if you have a friend who's a fan of Warren Buffett, make sure to share this video with them, and let's see what they say in the comments.